watching your portfolio this morning, you probably expected an absolute bloodbath. I mean, usually when we look at the financial markets, there is this expectation of basic underlying gravity, like physics.
Right. Supply lines get bombed, oil prices go up.
Exactly. Or, treasury yields spike, so equity valuations come down. It's supposed to be, well, somewhat predictable. But then you get a trading session like today, Tuesday, July 28, 2026, and suddenly that gravity just turns off.
It completely disappears.
Yeah. We're looking at a market landscape today that is honestly just completely defying the textbooks. Welcome to Market Recap. I'm Daniel.
And I'm Mira.
Today, we are taking a deep dive into a really heavy stack of market reports, geopolitical dispatches, and corporate filings, just to figure out exactly why market gravity broke today. I mean, we witnessed a spectacular V-shaped recovery in U.S. equities alongside a massive plunge in crude oil.
Which is wild.
It is. And the kicker, this all happened despite lingering very severe geopolitical tensions and some incredibly sticky macro data.
Yeah, we are going to explore how tech giants are essentially, becoming shadow banks just to sustain consumer demand. And we'll also get into why the bond market is acting so violently ahead of a pivotal Federal Reserve meeting.
It really is the absolute definition of a market decoupled from its fundamental backdrop.
Totally. And we are here to help you understand the baseline you're operating against, not to endorse the market's seemingly irrational view.
Right, exactly. And just to be completely clear right up front, this deep dive is for market context and discussion only. This does not constitute personal investment advice or, an investment recommendation.
Got to get that out of the way.
Always. So to understand today's wild decoupling, we have to start by asking our session one question. What set the stage before the U.S. session?
Well, to really understand the U.S. trading day, you have to look at the incredibly tense baseline that was established overnight. The overarching narrative was heavily driven by the Middle East, specifically the complete stalling of Omani diplomatic efforts. Yeah, this broke overnight, right around 2:25 a.m. Eastern Time. Oman was basically trying to establish a Malacca-style joint management framework for the Strait of Hormuz.
Wait, let's actually break that down for a second, because the Malacca model gets thrown around a lot in maritime security circles.
It's jargon, yeah.
Right. What does it actually mean?
So the Strait of Malacca, which runs between Indonesia, Malaysia, and Singapore, is one of the busiest shipping lanes in the world. But instead of one single country dominating it, they use a cooperative model.
Oh, interesting.
Yeah, it relies on voluntary transit fees paid by the shipping companies to fund joint navigation and security patrols. It's shared control. And Oman wanted to replicate that exact framework for the Strait of Hormuz, to guarantee safe passage and stabilize global energy markets.
But Iran wasn't having it.
Not even a little bit. Iran's Deputy Foreign Minister, Garibabadi, completely rejected the proposal. He demanded that all inbound shipping be under sole Iranian control. And he went a step further, explicitly warning that any European ships approaching the strait would be considered legitimate targets. Naturally, U.S. officials immediately rejected these demands as a massive overreach of sovereignty.
Okay, wait, I'm struggling with the reflex here a bit.
Mm-hmm.
The market constantly treats these geopolitical events like unpredictable natural disasters.
Right.
But if we look at this through a game theoretic lens, isn't this just classic geopolitical escalation as game theory brinkmanship?
How do you mean?
Well, both the U.S. and Iran are anchoring these extreme maximalist public positions just to maximize their leverage before the actual closed-door negotiations happen.
Mm-hmm.
I mean, neither side actually benefits from permanently closing the world's most critical energy choke point, right?
No, you're spot on. And that is exactly why you aren't seeing crude oil instantly spike to $200 a barrel.
Right.
If you view the extreme rhetoric as a negotiating tactic rather than, a final policy, the structural risk premium shifts. Iran wants leverage, not a total blockade that destroys their own export capacity.
Makes sense.
But even with that nuanced view, the rhetoric still set a very heavy tone overnight. And it wasn't the only thing dragging on sentiment either. We also had major policy signals coming out of Asia.
Right. Late Monday evening, around 10:07 p.m. Eastern Time, Japan's finance minister, Katayama, made some highly consequential remarks regarding the yen.
He did. Katayama clearly signaled Japan's continued transition toward an interest rate-focused monetary policy. He emphasized that Japanese inflation is actually rising in a quote-unquote healthy way and made it very known that they are absolutely ready to intervene on foreign exchange volatility.
Which is huge. And for anyone wondering why the Japanese finance minister talking about inflation matters to your U.S. stock portfolio, we had to quickly touch on how the yen carry trade actually works.
Oh, yeah. It is the invisible engine of global liquidity.
Exactly. For decades, Japan has had essentially 0% interest rates. So if you are a massive hedge fund, you can borrow Japanese yen for practically free. You take that free money, convert it to US dollars, and use it to buy US Treasury bonds or, high-flying tech stocks that yield 5 or 10%.
And you just pocket the difference.
Right. But when the Bank of Japan starts signaling that they're going to raise rates and defend the yen, suddenly your essentially free loan gets a lot more expensive.
And if the yen appreciates against the dollar, you are losing money on the currency exchange, too.
Exactly. So what do these funds do? They panic. They sell their U.S. assets to get dollars, convert those dollars back to yen, and pay off the loan before it gets too expensive.
It's like Japanese tightening acts as a giant vacuum cleaner, sucking massive amounts of global capital out of the U.S. and pulling it back to Tokyo.
So you have the Middle East effectively freezing up with threats of missile strikes, and Japan threatening to turn on the global liquidity vacuum.
A heavy setup.
Very. You'd expect U.S. markets to open in a full-blown panic. But we're going to take a short look, and when we come back, we'll dive into why that absolutely did not happen.
Stay with us.
Welcome back to our deep dive. So moving on, we have to ask our Session 2 question. What moved markets during U.S. trading hours? Because what actually happened on the trading floor completely defied that overnight setup we just talked about.
It really did.
Take us through the tape.
The tape was just extraordinary. We saw massive, dramatic intraday swings today, July 28. Early on, the gravity seemed to be working. The S&P 500 futures fell to an early hourly low close of 7,420.75.
Ouch.
Yeah. And the Nasdaq 100 dipped all the way down to 27,665.25. But they didn't stay there. Both staged this massive V-shaped rally.
It was crazy to watch.
By the afternoon, S&P futures hit highs of $7,484, and the Nasdaq soared to $28,057.50.
And while equities were ripping higher, crude oil was inexplicably collapsing. Crude fell from $82.11 down to an hourly low of $78.36. And as the market rallied, the VIX, the fear gauge, it compressed down to 18.21. But here's the thing. The actual economic data we got during the day does not support this level of blind optimism.
Not at all. I mean, at 10 a.m. Eastern Time, we got the U.S. Consumer Confidence Index. It slipped to 90.8.
Not great.
No. And while headline inflation expectations moderated a bit, a stubborn 61.3% of consumers still expect higher interest rates over the next 12 months.
So the consumer is telling us they're feeling the squeeze.
Yes. And the bond market is screaming the exact same thing. At 12:45 p.m. ET, the Treasury held a $44 billion 7-year note auction.
And it tailed badly.
Really badly.
Let's translate that for a second. Think of a bond auction like the government throwing a party where they need people to bring cash.
Okay, I like this.
A tail basically means nobody RSVP'd to the original invitation.
Yeah.
So the Treasury had to offer much better prizes, which in this case means significantly higher yields, just to get buyers through the door.
That is a perfect way to visualize it. The auction cleared at a high yield of 4.473%, which is a huge jump from the previous 4.260%. And it did so on mediocre demand with a bid-to-cover ratio of just 2.490.
Which is low.
Very. When that ratio is that low, it shows institutional buyers are exhausted. They don't want to absorb any more government debt unless they are heavily compensated for the risk.
And if that wasn't enough bad news, right around mid-morning, 11:10 a.m. ET, we got reports that the Yemeni Houthis were escalating their maritime blockade. They actually launched ballistic missiles at Saudi oil tankers.
Direct physical threats to Saudi crude transport infrastructure happening in real time.
Okay, I have to stop right here because the math simply isn't mathing.
Right.
If that 7-year Treasury auction is showing us risk-free yield as gravity-compressing equity multiples, meaning higher yield should fundamentally drag stock prices down, and physical oil supply lanes are actively under fire from ballistic missiles. How on earth did oil plunge and equities rip higher? Are equity markets just too neatly pricing in a dovish pivot from Fed Chair Kevin Warsh tomorrow? Or are oil markets entirely mispricing these energy shocks as multiplicative supply inflation?
Well, it is the multi-trillion-dollar question, isn't it? What we are likely seeing is a massive game of chicken with the Federal Reserve.
Oh, okay.
The equity market might be looking past the immediate data. They see the weak consumer confidence, they see the exhausted bond buyers demanding higher yields, and they are banking on the idea that the Fed will view this as a breaking point.
So they think the Fed will fold.
Exactly. Equities are rallying because they assume the Fed must step in and cut rates to save the economy, regardless of how sticky inflation is.
Bad news is good news, all over again.
You got it. Meanwhile, the oil market is looking at that exact same weak consumer data and coming to a very different conclusion. They are pricing in severe demand destruction. If consumers are tapped out, they won't buy goods, factories won't run as hot, and global energy consumption will drop. The oil market is betting that a recession will destroy demand faster than a missile strike can destroy supply.
So this massive macro disconnect really forces us to look beneath the surface. Clearly, the market completely decoupled from the gravity of interest rates and geopolitical angst today.
Absolutely did.
We're going to take another quick break, but when we come back, we'll dive into the corporate micro-narratives, which might actually explain this macro optimism.
Don't go anywhere.
And we're back. So if the top-down data doesn't explain the equity optimism, maybe the bottom-up corporate engineering does. Which brings us to our Session 3 question, corporate events recap and what to watch next. Because the mega-cap tech giants are getting incredibly creative with how they finance their operations right now.
Oh, they absolutely are. And the most glaring example of this came from Apple this morning at 8:15 a.m. Eastern Time.
Yes.
Apple is making a massive structural pivot in how it handles consumer credit. They are entirely discontinuing their classic iPhone upgrade program and their direct payment plans in the U.S.
Wait, entirely?
Entirely. Instead, they're partnering with Klarna to offer 12 to 36-month hardware leases.
Okay, on the surface, you could look at this as a genius margin preservation move by Apple. But let's dig into how this actually works mechanically. Why wouldn't Apple just keep financing these phones themselves? Or, rely on credit cards?
Because Apple wants the revenue recognized today, but they know the U.S. consumer is heavily constrained. By partnering with Klarna, Apple completely offloads the direct balance sheet credit risk.
Interesting.
Klarna pays Apple the full price of the phone up front. Apple gets to report massive quarterly hardware sales and protect its cash flow.
And what does Klarna do with millions of microloans for iPhones?
Well, they certainly don't hold all of them. Klarna bundles these 36-month buy now, pay later loans together, securitizes them, and sells them to Wall Street as asset-backed securities.
So it's essentially shadow banking.
It's 100% shadow banking.
Man, this is a giant red flag for the broader economy. It means the consumer is so tapped out that they literally can't afford to buy a phone without relying on complex securitization crutches stretched out over 3 years.
Exactly.
It masks macroeconomic demand destruction by artificially keeping the velocity of consumer upgrades moving.
Yes. It provides the illusion of affordability, which sustains Apple's valuation, but it transfers the default risk to the broader financial system.
Wow.
And it isn't just consumer credit getting creative. We are seeing extreme financial engineering on the corporate debt side, too.
Right. Earlier this morning at 5:33 a.m. ET, we saw reports about a BlackRock-linked entity marketing $12.3 billion in senior secured notes. And this was specifically for Meta's new El Paso AI data center, Project Sopapilla.
Right. And this perfectly illustrates AI capex as a self-defeating valuation loop.
Oh, so?
Well, hyperscalers like Meta, Alphabet, and Amazon have committed to a mind-blowing $700 billion AI supercycle.
Well, that number is just staggering.
It is. They are locked in an arms race. But their internal cash flows, as massive as they are, simply cannot keep up with that level of capital expenditure.
It's wild to think that a company printing money like Meta still needs to borrow $12 billion just to pour concrete and buy servers.
But they do. They have no choice but to tap complex private credit markets and form joint ventures like this 80-20 split with BlackRock just to build the infrastructure. And the reason these data centers are getting so expensive is that the physical bottleneck is shifting.
Right. We aren't just constrained by getting our hands on the silicon anymore.
No, the AI bottleneck is rapidly shifting from compute to electricity.
That's a huge shift.
It is. Project Sopapilla alone is a 5-gigawatt facility. To put that in perspective, 5 gigawatts is enough to power millions of homes. The sheer amount of power required to sustain this AI supercycle means these companies are practically having to build their own power plants alongside the data centers.
Speaking of the constraints on silicon, though, the geopolitical squeeze on the chips themselves hasn't gone away at all. Late Monday at 4:31 p.m. ET, it was reported that Nvidia CEO Jensen Huang was heavily lobbying in Washington, D.C., taking meetings with figures like Howard Lutnick.
Right. Huang is advocating for open-weight AI models, arguing they are crucial for safety and national security.
But look at the timing.
Exactly.
This D.C. trip is happening against a very fraught global backdrop. Over in Taiwan right now, authorities are actively detaining Nvidia staff as part of a major probe into illicit chip trafficking to China.
And at the exact same time, we have reports confirming that China has successfully begun mass-producing its own homegrown DUV lithography systems to bypass Western sanctions.
The tech Cold War is accelerating, making Nvidia's position incredibly precarious.
So you have hardware constraints at the top of the supply chain with Nvidia, massive energy constraints in the middle with Meta's data centers, and exhausted consumers at the bottom requiring Klarna to finance their iPhones.
And yet, despite all of that, the market rallied.
It did.
With the market staging a spectacular V-shaped comeback and Apple crossing the historic $5 trillion mark, we certainly have a major victory to celebrate at today's closing bell.
Yeah.
It seems the bulls were running so fast they almost ran right into Apple's new hardware leasing partnership with Klarna. Let's just hope that while we are busy financing our next iPhones over 24 months, our stock portfolios aren't secretly planning their own installment-based recoveries.
Oh man, a sobering thought for anyone holding highly valued tech.
Truly.
But looking ahead to tomorrow, Wednesday, July 29, the narrative could shift again very quickly. We have a gauntlet of forward-looking catalysts.
Give us the Wednesday rundown. What do we need to watch?
Okay, first, at 10:30 a.m. Eastern Time, we have the EIA Weekly Petroleum Status Report.
Which is vital for crude oil after Tuesday's massive sell-off.
Exactly. Then, at 11:30 a.m. ET, the U.S. Treasury holds a 2-year floating rate note auction. At 1:40 p.m. ET, we get the Treasury's preliminary buyback announcement. But the main events are in the afternoon.
The main event being the Fed.
You know it. At 2 p.m. ET, we get the highly anticipated FOMC policy decision. And finally, at 2:30 p.m. ET, Fed Chair Kevin Warsh holds his press conference, which absolutely has the potential to violently shift the entire yield curve.